This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, economic horror is imminent as alarming signs are now pointing to this country's collapse. And what's interesting is this is an outsider looking across the border and saying that things in that country are going from bad to worse, and they're starting to have contagion effects. And if you're wondering, that's exactly what we're doing in Taiwan today, because all of the experts, all of the policymakers said, if this country collapses, there's no way that it will affect the rest of the world. We told you that if this country goes down, everyone else in the world is going to follow it. And now we're getting signs that it's starting to happen. Let's over to Bloomberg, where we picked today's story up with a headline. Germany predicted to be the only major European economy to contract this year as recession lingers. Now, what's notable is today's story isn't all about Germany. In fact, they're not the country that we're saying is going to bring the world down. What we're saying with Germany is they're going to bring the entire Eurozone down. But what's surprising is experts are saying that's not going to happen either. As Germany is set for a prolonged recession this year, the only major European economy to experience an economic contraction during 2023. Europe's largest economy is predicted to post a 0.4% fall in economic activity. Now, what I want you to keep in mind is it's Europe's largest economy. So they're going to likely contract this year. That's 0.6 percentage points lower than an estimate made in May. And here we can see the institution also cut its growth expectations for Germany in 2024 from 1.4% down to 1.1%. So what's kind of interesting here is you get the idea that the largest economy, the biggest economic powerhouse, the manufacturing base in Europe is set to contract, and the popular belief is, well, everyone else around them will be okay. And that isn't how it works. You know, we talk about how the manufacturing sector, whether it's in the US or in Asia or in Europe, leads the services sector by an average about 2 months, whether to the upside or the downside. So when we start to see a sustained decline in manufacturing, we know the services is soon to follow. Well, what's interesting here is we see the same effects that no one believed that to be true, and now it's happening. And yet at the same time, they say, look, if the manufacturing base in Europe goes down, well, the peripheral countries, they're going to be okay. Not going to happen at all. It's just they're okay right now. As Germany's situation differs crucially from the trouble of 1995 to 2004, first, they enjoy record employment, high demand for labor, and the most comfortable fiscal position of all major advanced economies. That makes it much easier to adjust to shocks. But if you may recall, last week we talked about the flash PMIs. We had the data from the manufacturing sector and the services sector out of Germany, both of which we covered on the show. And what did we see out of the manufacturing sector? We saw depression level prints. We saw notable remarks that they weren't seeing an influx in new orders. In fact, new order demand was low, and that for almost a year, they've been working through backlogs. And so right now, they say, well, hey, the labor market's okay. And what we keep saying, at some point, when you don't have any more new orders coming in, and your backlogs are worked through, and you've got idle employees standing around, they're going to hit the unemployment line, and that's coming to Germany. It just hasn't happened yet. While at times many people think these effects should be instantaneous, well, they're not. And that's one of the challenges, because once the layoffs start hitting the German manufacturing sector, watch out for the rest of Europe. It's coming. And weakness in domestic demand, in particular consumption, shows that high and still increasing consumer prices for most goods and services are taking a heavier toll than expected. Now, this is almost a staggering remark that, yes, high inflation causes problems. And as we talked about on the show, it's particularly an issue when wages don't keep up with it, because people can't afford higher prices. When they can't afford higher prices, they cut back their discretionary spending. And next thing you know, the wheels of the economy start to slow. And the only people that seemingly baffled by this were all the policymakers. And high inflation continues to be one of the main challenges in the bloc. The latest forecasts show that consumer prices will come down in the coming months, as we've said they will, but they are still likely to be above the European Central Bank target of 2% by the end of 2024. Well, let's put it this way. If the German economy at best just has a recession, which I think it's going to be far worse, they're going to drag the entire peripheral bloc down with them and all those other countries. You're going to see a recession, if not a depression in the the Eurozone. You want to talk about inflation coming down? Well, it's a good way to do it because when you're in a recession or even a depression, demand goes down so much that inflation often turns into deflation. And here's the evidence that we are likely to see a recession even in the U.S. This is going across the world right now. But let's take a look at the consumer price index, this shown in blue, on a year-over-year rate of change. And we've got this against total compensation. This is average weekly hours multiplied by average weekly earnings of production and non-supervisory employees. So we're going to look at the U.S. picture here and kind of transmit this across the world to what other economies are experiencing. Because what I want you to see here is you'll see times where inflation is running high, and you see that up here in the 1980s or late 70s going into the 1980s, and you see total compensation is lagging behind there. So this gap is where, of course, workers cannot afford higher prices, so their spending decreases. And then all of a sudden, you'll see compensation jumps over that, and all of a sudden the policymakers get really excited, but it's too little, too late. And so what I want you to see is going into every recession, it's usually led by the fact that compensation, total compensation, is lagging behind consumer prices. When that happens, eventually consumer prices do come down because this is a demand. If you want to see demand in itself, you can look at total compensation. So right now we see the policymakers are excited that wages are finally above inflation. But what our problem with this is, how has the economy been running at the pace it has been? Well, consumers have been tapping debt. They've been maxing out their credit cards, and that's the issue here. As you face the fact that credit cards are tapped out and wages are lagging inflation, eventually this all comes to roost and we have a recession. The problem is, in the Eurozone, people don't believe that what's going on in Germany is going to affect the other countries around it. In our case, is it absolutely is going to affect them. And someone else who's in complete denial, well, that's our Treasury Secretary, Janet Yellen. As Yellen is feeling very good, she says, about a soft landing for the U.S. economy, and something you should be feeling good about as well is your trading account. Let's do a quick update on our CTA-Timer Pros call on the crude oil market. If you were following this pullback, you saw the machines jump on this gap up move. It would have triggered a buy it open based on our report on that day right there. That trade would be at 4.6% right now. We think, based on the fact that it's breaking out of this range and the machines are long, what that means is this trade could be a 10 to 12% return. We think it's going to get up there to the $93, $94 range. Here we are looking at the August 31st report. We saw the machines turn and buy into that upswing. That was the initial signal to take a trade. Here you can see they're maxed out to the long side. That happened on September 4th, and they're still maxed out there, and you can join in on how to use CTA-Timer Pro to improve your trading. Link in the description below. It's a mere $30 a month and comes with a 14-day money-back guarantee, something I think our Treasury Secretary is going to need on that statement of saying that she's feeling good. The only question is, for how much longer? And here you can see the 10-year Treasury constant maturity against the 2-year. This is the yield curve. So we take the 10-year, subtract the 2-year. When this inverts or goes underneath the black line, well, that's when bad things happen. And according to Yellen, she's feeling really good about where monetary policy is at, as we'll get into what she says here in a little bit. But I want you to see that she believes inflation is coming down. Well, it is, because anytime the central bank inverts the yield curve, we set down the motions, the beginning of what is a decline in inflation. You can see it here in the late 80s again. Then, of course, you see an inversion. And yes, inflation did go up, and then it comes crashing down, because the yield curve doesn't tell you with a time that it's going to happen immediately. It just tells you at some point in the future, demand's coming down. And sure enough, we see that, going into the dot-com bubble, into the global financial crisis, heading into the pandemic, which, remember, was a global slowdown, and now we're seeing it again. So we're making the case that her feel good about whether we're going to have a soft landing is likely going to change in a big way, because if we look at what she's saying here, she's saying that the data is hailing a slowing in prices. Well, that is true. But the question is, are we going to see a soft landing? Well, the CPI, when you see these big decelerations, well, you'll notice they happen during recessions, or they lead into recessions. So now let's take a look at this chart here, where we overlay the 4-week moving average of initial claims, because we're going to talk about the labor market as well. When you see these inversions, what normally happens? People start losing their jobs, and you see this repeat. These inversions lead to layoffs, and sometimes they happen right at the same time. And so you see it happened here again in the late 80s into the 90s. You see it happened here in the early 2000s. You see again the yield curve invert going into the global financial crisis. Layoffs happen there. You start to see it right before the pandemic, and you're seeing it now. You see it almost at the time of inversion. We bottom out on the initial claims. They're headed higher. Everybody thinks over time they're headed back down. We're making the case that everything is going the other way. But look at this. She says, every measure of inflation is on the road down. Now, we've made that case that this is true. This is correct. She also highlighted that while the U.S. unemployment rate increased in August after reaching the lowest levels in more than half a century earlier this year, that jump wasn't caused by a large wave of layoffs. And she's right. It wasn't. It was caused by a small amount of them. But what we're making the case is that things are building here and that we're going to see a material shift in the economy, particularly when all of that pandemic money dries out. And then I think at the same time, we're going to have the effect of those student loan repayments resuming, not to mention the effects of higher interest rates on credit card minimum payments at a time we know when most people are maxed out on their cards. Yellen reiterated the view that China's policymakers will still scope to step up if needed to support the economy. Of course, any former central banker always thinks more support is needed, as Xi Jinping's team has taken a number of measures to loosen restrictions on property market, but stopped short of broad stimulus packages for consumers or sweeping interest rate cuts. And she says, I think they have quite a bit of policy space if they decide it's necessary to use it. They've made what seem to be like relatively small adjustments in monetary policy, suggesting that if they hired Janet Yellen to be their chair of the PBOC, she'd probably be slashing rates and encouraging massive amounts of stimulus, because what she's telling us in this report is, while she doesn't see the U.S. economy heading into recession, we're making the case we're not going to see a soft landing. We're going to see something far worse. If we're lucky, we'll just get out of this without a financial crisis. But given the health of our banks at this time, it's highly likely that we're going to see tens or dozens of banks fail in the future here. And that's going to be a problem, telling us that we're headed for a recession and a financial crisis at the same time. But as we know from Janet Yellen's past, who could not see the housing market blow up in her own backyard, she's saying, look, over there in China, they need to do something. But in this case, she's absolutely right. But as far as what the Fed's going to do, well, they think they need to tighten some more. As Fed's Williams says, policy in good place must be data dependent. He says, of course, that's what every central banker says, because nobody understands the data quite like they do. And I think we've gotten monetary policy in a very good place in terms of we have a restrictive stance in policy. So I want you to listen to what he's telling you, because wait till we go a little bit further here. He's saying, look, after a year and a half of raising rates, which is what they've done, we've finally gotten it there. Now, if they knew where the restrictive place was, they would have gotten there quite a bit quicker, but they don't know. And that's the evidence here, is they don't know where restrictive monetary policy it is. Now, granted, the yield curve already tells us this, but they don't look at the yield curve. So hear him out now. He's saying we're finally at a level where monetary policy is restrictive. He goes on to say, as the New York Fed chief, that policy is having the desired effects of bringing demand and supply more into balance and easing inflation. Now, what is bringing that down is the banks aren't creating as many loans, so people don't have access to credit to take that money and consume. Not to mention, of course, as we've already pointed out, total compensation is lagging behind inflation, which is a key point. But let's go on. He says that supplying to balance and easing inflation, adding the Fed has, quote, done a lot by raising interest rates significantly. At the same time, officials must calibrate policy if needed to ensure they're bringing inflation sustainably down to their 2% goal. So here's what's interesting to me. He's saying, well, we're in restrictive space, but apparently there's a big zone of restriction. Sometimes there's like high restriction, low restriction. So he's saying we have to calibrate it, almost giving you this effect that they are scientists or engineers and they need to dial it in so it's just right. And that is, of course, the myth of central banking entirely. But let's continue on here, because we can see the effects of what's happening in monetary policy from the demand side. And that's what he referred to, is he thinks he's bringing supply and demand into calibration. Well, the case for that is 100% true. Whether or not it was the intended effect the way they want it, well, we're going to make the case of it's going to bring demand far lower than they want. So here we can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. And we know that when the yield curve inverts and banks can't make money because they borrow at the short end of the curve and lend at the long end of the curve. So when rates are inverted, they lose money on lending, that they tighten lending standards, which is shown here in blue. And again, anytime it's over that horizontal black line, on net banks are tightening. And we got this against the Philly Fed's new order book. And so what we can see is when banks start tightening lending standards, eventually that transmits into the economy and new order growth goes down. You see that here in the dot-com bubble. You see it in the global financial crisis. You see it in 2015, 2016, start to have a small effect, and you're seeing it now, with the exception that we're seeing kind of a resurgence in new orders, making the case here that if new order growth rolls over and heads lower, it's game over for the U.S. economy in a big way. But we'll have to keep watching the data carefully because we're central bankers, analyzing all of that and really asking ourselves the question, is this sufficiently restrictive, suggesting that maybe we're not? Maybe do we need to raise rates again to make sure that we're keeping that steady progress in terms of shrinking imbalances in the labor market and bringing inflation down? So I want you to hear now what he's saying is these imbalances in the labor market. Now, from a central banker's perspective, what they're telling you is there's too many jobs and not enough workers, and we have to bring those numbers in balance. We either need more people to come back into the workforce, or we need the number of job openings to go down. What he's really trying to tell you is those big raises that you need to keep up with inflation, we don't want them. In fact, we're okay with you getting a raise as long as it's not that much, and that's what they really want here. They want all those people that are employed now to get lower wage increases, and that means, of course, demand continues to go down, brings inflation down. They don't care if the number of job openings come down. That's just the data. That's what they look at and tell you. But the truth is they don't want you to make as much money at a time when most Americans can't keep up with inflation anyways, as we've already made the case. And now let's talk about what's going on and why we're in Taiwan today, as the envoy sees an alarming sign in China's economic slowdown. China's economy is showing clear signs of a slowdown that will have an inevitable spillover to the region. There are some alarming indications that we are impacted. Despite all the political and strategic tension, which we could just set aside, we are interested in prosperity for people on both sides of the strait. So here we've heard in the past, and not too long ago, that if China could pull the world out of this global slump, and then it turned out they didn't, their reopening had kind of a muted effect. The Chinese people didn't come out and spend a whole lot of money, and now all of a sudden, then everyone turned and said, well, if China goes down, which we can see happening in their property sector, well, we won't be affected. So what's interesting is we can be affected to the upside, but not the downside. We made the case on this show. It says, look, if China goes down, it's going to have repercussions across the entire world. It's going to bring the global economy down into a recession. And now we're starting to see the first glimpse, this out of Taiwan, saying, hey, wait a minute, they're going down. And wait a minute, we might be going right along with them. The slowdown has sharpened Taiwan's focus on reducing its vulnerability to the world's number 2 economy, with business actively considering ways to diversify their operations. So I want you to see this because, China is the world's largest exporter. So Taiwan's solution is, hey, wait, they're going down. We need to diversify away from them. Well, maybe the issue isn't you need to diversify away from them, is you need to look around the global economy and see that central bankers have inverted yield curves across all these different continents, and what's causing is less money growth and less demand, and you can move your business away from China. It won't make a bit of difference. Where China goes is just a proxy of telling us demand in the rest of the world is crashing, and we're all eventually going to follow them down. And look at this, even President Joe Biden's on the bandwagon, saying China's a ticking time bomb, which we'll totally agree, citing a number of economic problems in the Communist Party is facing. And that's us good, because when bad folks have problems, they do bad things. Well, the problem is when bad folks have bad problems, the good folks eventually are going to have them too. And China is Taiwan's largest trading partner, accounting for 25.2% of total trade and 21.6% of Taiwan's imports, according to the recent data. The U.S. comes in second, accounting for 12.6% of Taiwan's total trade and 10.2% of imports, suggesting without demand coming out of from China over to Taiwan, suggesting Taiwan's economy is going to contract as well. And yet China is still trying to put up the brakes on this as they ease rules for insurers to buy stocks in support measures. So again, we make the case that things in China are far worse than anyone wants to believe because they want to stop their stock market from going down. So what's a great solution to this? Take your insurers, people who you need to have money in case of emergencies. That's what insurance companies do. Well, go ahead and speculate on the stock market, because if it goes down, well, those insurers, well, they'll be next on the list of companies to fail. The risk weighting will be lowered for insurers' investments in the CSI 300 index, as well as stocks listed on the STAR market, according to new rules issued by China's National Administration of Financial Regulation. The minimum capital requirements for insurers will also be cut. This may lead to insurers speeding up the flow of funds into the capital market after the new rules. Of course, we'll find out if they are so bold enough to take that risk. And that's something, I don't know about how you feel, but I would not want my insurance companies speculating on stocks, particularly in a down market, as the means to prop a market up that doesn't give you any good feelings in case things go wrong. But the move is aimed at guiding insurance to support capital market development and technology innovation, according to a statement. Of course, we know the real reason is to keep the CSI 300 from going down. But the problem is when you see a decline in inflation, keep in mind China is currently experiencing factory gate or PPI deflation, and their CPI is just narrowly almost in deflation. What you see is stock markets tend to react. Here we're looking at the U.S. Consumer Price Index against the Wilshire 5000 or total U.S. stock market. And you'll notice that as inflation comes down, well, the markets on a year-over-year rate change, they come down too. But there are times they fight against it, saying, hey, look, we think inflation is going to have a soft landing here. We think they nailed it. And then when it doesn't happen, because it never does, you see a stock market reverse. But most of the time, you see the stock market leading inflation to the downside, which is contrary to what a lot of people believe. And right now, you see the U.S. stock market buying 100% into that soft landing story, a case that we're saying is not going to happen, and eventually stocks are going to head lower. And yet China warns traders on the yuan speculation, fueling a sharp rebound in the currency, adding to the hope that they think they can stabilize a fiat currency. Good luck with that, because the nation's financial regulators will take action to correct one-sided moves in the market whenever it's needed, and they're confident in keeping the yuan basically stable, which, as I've made the case, they need to do for means of global trade. But the problem here in China is that things are bad. They're getting worse. It's going to create an economic nightmare, and we can all see it coming. The only question now is when. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.